if we're talking about, let's start with the defined benefit plan. That was you guys. Okay, so if you started a job, what would be the benefits of having a defined benefit plan? Does it sound like something you'd want to have? Yes. Okay, why? Huh? Well, it's a benefit, yeah, but they're going to tell us about I always have to look at the title. They're going to talk about a defined contribution plan in a second, and so we're going to see the difference. So what makes a defined benefit plan sound good?
Long term.
Okay, long term.
When you retire.
When you retire, it's there. Who's paying into it?
Employer.
The employer is paying into it. All right, and so can you get it immediately, or do you have to have it during a vesting period? Is there a vesting period? Okay, a vesting period. Do you have to contribute at all, or is it 100% your employer? 100% your employer. Okay, so on defined contribution plan, what's that plan about?
Well, it's more like the traditional 401s where you can put into it yourself and you may or may not have employer match.
Okay, so there we're contributing, and hopefully we're lucky enough to have our employer match, which is very good because some employers don't do that. Okay, and then it's also long-term, 59 and a half before we can take out. Is there a vesting period with that?
There can be a determined vesting period for the employee contributions, but I thought it said that the employer part was immediate.
I think it's the other way around.
Backwards.
You can always get your money with penalty, not their money, because it's your money. Okay.
10% penalty.
Yeah, there's always, if you take it out before you're 59 and a half, it's a 10% penalty. Now, what's interesting is I have someone that I help do their taxes, and he's over 59 and a half, and he contributes. So he benefits from some of the tax benefits of contributing to something like this, getting the tax benefit, but then he can take it out as soon as he needs it because he doesn't get a penalty. So but that's okay because he doesn't always need it, but he doesn't, I don't want to say suffer, but if you and I put too much money in, then it just has to sit there, or we have to adjust it down the road by a percentage. So defined benefit is 100% employer. Defined contribution is the word contribution, and we put in, and we hope our employer puts in. So just at that level, which one sounds a little bit better?
Defined benefit.
Defined benefit, okay? Sometimes people call it a pension, because in a pension, your employer is putting in, and it's something that you typically get. Pensions are not as common as they used to be. All right, the contribution plans are a lot more common. Every company that I worked for had a contribution plan, and so I was lucky, whether it was AT&T or Mallinckrodt, and then before I came here, they all also contributed. They contributed at different amounts, but they contributed. Now I work for the state. I would call it, I don't know what you call the state because it's mandatory. So that's a little bit different than a defined contribution. Defined contribution, I get to pick whether I put my money in. I don't get to pick anymore. So it's kind of a cross between a contribution plan and defined benefit because I have to put in 14.5% of my salary, but the state matches 14.5% of my salary. So it's very good, match, but I don't get a say. I have to put in 14.5% of my salary. Now, as a teacher that's been teaching for a while, that's not too bad, but a lot of people think that cripples some young teachers who start off right out of college who don't make as much money to have to put in 14.5% of their salary. In the long run, as long as it's there, it's going to pay off very nicely because getting 29% savings of your salary every year is very good. Not a lot of people put that much money aside.
And that's still all on a pre-tax basis, right?
It's pre-tax. Yeah, that's pre-tax. Which we're going to talk about that in a minute. Okay, so when we're looking at our wonderful little plan, so we're going to go through and look at the different plans, and we kind of just talked. One of the things is you cannot discriminate between employees. So if you offer a defined benefit plan to executives, guess what? You offer a defined benefit plan to everybody, and then vice versa. Not that it usually goes that way, but you have to give it to everybody. So some of the standard benefits is the maximum benefit in 2016 is $210,000. And then there are some funding requirements on the defined benefit is one of the things you guys said. The employer bears the risk, not us. We're not at the risk of losing any money, which is nice. There are two different ways to vest with the defined benefit, and they both defined contribution vests also, but on a different schedule. There's a 5-year cliff, and then what they call a 7-year graded, and I'll show you a schedule of that in just a second. They're taxable when we receive them. It's taxable as ordinary income, and the reason it's ordinary income is basically it's supposedly income when we retire, therefore it's wages and salary. It's nothing but wages and salary down the road. It's not capital gains or anything like that, it's wages and salary. So for example, this company provides a defined benefit plan to its employees. Under the plan, we earn a benefit equal to 2% for every year of service on an average salary for their 3 highest years. They implement it on a 7-year grading vesting plan. If Tina works for CBA for 4 years earning those 3 salaries and then leaves to work for another employer, what benefit would she be entitled to? Now, it says the 3 highest years, so obviously 65, 70, and 75. You average that out, and it's 70. All right, and it's 2% for every year of their average salaries. Now, actually, what's interesting is that's kind of how ours is done. It's based on our 3 highest years. And ours, I believe, has to be in a row, though. Like ours is 3 consecutive years in a row, I believe. I haven't looked into retirement that much because it's not that close. All right, so when we take a look at this, $70,000, like I said, she's been there 4 years, so she gets 2% a year. That's $5,600. Now, I'm going to show you that the 7-year graded in a second, but based on that schedule, because she was only there 4 years, she only gets 40%. Graded means you get a percentage. The 5-year cliff means if you don't hit 5 years, you don't get anything. Right? And a lot of them are like that. You make it or you don't make it. When I was at AT&T, it was a cliff. I can't remember if it was 3 or 5. But if you didn't get to that point, you didn't make it. Mallinckrodt was the same way. Now, Mallinckrodt still had a defined benefit plan. AT&T did not. AT&T's was a cliff for what they matched in your 401k. Mallinckrodt still had a benefit, and theirs was a cliff. But what happened is we got bought out, and when you got bought out, the cliff, everyone vested immediately. So it didn't matter how long you'd been there, you immediately vested to 5 years. So you didn't have to worry about the cliff. So basically when she goes to leave, instead of getting $5,600, she's going to get $2,240. But also keep in mind, this isn't her money. This is money that they put aside for her. All right, now the contribution plan, this is a little bit more like you were saying, this is a little bit more like what most companies are going to have. This is when we put our own money in. This is before tax, typically. You can do after tax, but typically it's before tax. And if we're lucky enough, our employer is going to match it. They don't typically match dollar for dollar for whatever we're going to put in, but a lot of times they'll either do dollar for dollar up to 2% or 3%, or sometimes they'll do something like 80% on the dollar for the first 5% or something along that line. So if you can get your employer to match anything up the first 4% or whatever you get, 5%, that's good, especially if it's dollar for dollar. And if you can't afford to put a whole bunch of money into your contribution plan, you want to make sure you're putting in whatever they're going to match, because if you don't, you're basically losing money because they're going to match whatever you put in, so you want to try to match that as well. Now, there's limits for contribution plans. It's $18,000 if you're not 50, and it's $24,000 if you're over 50. So they allow you to put more money in. And then your employer plus your employee cannot exceed $53,000 or $59,000 if you're over 50. or 100% of your compensation, which I love that one. It's kind of like the charity that can't exceed 50% of your income. You know, if anyone can give 50% to charity, that's great. If you can save 100% of your salary, that's awesome, right? So, but it can't exceed 100% of your compensation. So before Dave retires at the end of the year, he continues to contribute to his CBA-sponsored 401k. CBA matches employee contributions on a 2-for-1 basis up to 4%. Dave is 72 years old at the end of the year, and he earned a salary of $450,000. Dave contributed $24,000 to his 401k. How much would CBA contribute to Dave's account? So what we got to figure out is Dave contributed $24,000. CBA contributes 2-for-1 up to 24,000. 2-for-1 up to 4%. So 4% of Dave's salary would be how much? 4% of 450 is 18,000. Okay. So a 2-for-1 basis would be for every dollar,
So 36,000.
36,000. So they're only going to go up to 18, is what we're saying. They're saying, I think you're looking at the other way. Okay, you had your 2-for-1 flipped. So they're going to put in 4% times 2. They're going to put in $2 for every one of Dave's 2-for-1 basis. So if Dave's putting in 24,000, they'd put up to 48. But they're not, based on that formula, they're not going to. Okay, so it's 450,000 times 4% times 2, which would get us $36,000. Now, you have to then look at, though, the maximum contribution for Dave, he's over 59, is $59,000 a year. 59 minus 24 is 35. So you can only contribute, they can only contribute 35,000. They cannot contribute 36. Now notice what Dave's salary is. Dave's salary is $450,000. Okay? So that limit of $59,000 is going to be for high income people. You're not going to hit a contribution limit of $59,000 unless you're saving half of your income when you're making $110,000 a year. All right, that's for high income salaries.
I thought that once you hit 70 and a half, you had to start taking the mandatory distribution, the mandatory distributions that you could no longer contribute.
No, you can contribute, but you have to take it back out. So you can RMDs, required minimum distributions.
Right.
You can still put money in, but you have to take money out too.
We were misled then because it's a different situation.
Right.
But we were
But
told
this
that
is
once
also
you had
why
to
he's
start
working.
taking out, you could not contribute anymore.
Okay, and this is a contribution plan. You might be thinking of just a strict individual 401k.
Because with the individual,
You cannot put into an individual
IRA,
401k.
you can't, right?
No, you cannot put into an IRA. You cannot put into an individual 401k. This is a work contribution plan.
Okay.
He's still working, so that's what's allowing him to do that, right? A lot of people after they're working 70 and a half aren't. I mean, a lot of people who are taking after they're 70 and a half aren't working. So it's a different. Okay, so the vesting period, like I talked about before, the other one was 5 and 7. This one, you vest immediately on your contributions. That's what we were talking about. It's not the employer. You vest on yours because you put your money in, you can get your money out. Employer contributions and the earnings on your contributions are a 3-year cliff and then a 6-year graded. So it's a little bit quicker. It doesn't take 5 years like the defined did, but it's still it's a 6-year graded. And this is an example of the vesting schedule. So on the left is the cliff, and you can see basically it's 0, 0, 100. So on a defined plan, it's 0, 0, 0, 0, 100. You get nothing until that last year. On the on the graded schedule, it just gradually goes up. And so on a 6-year, it's pretty easy, 0, 20, 40, 60, 80, 100. On a 7-year, it's not quite as, it doesn't go up by 20% like that. It's a little bit more. All right, so now early distributions, it doesn't matter. On defined contribution, you are still getting, it's still ordinary income when you get it. And you are gonna be taxed for the 10%, 59.5, or if you're 59, 55 and you're separated for service, okay, that would be another, example. Okay, so what about Lisa? Lisa's 57, she's still working, and she requests a $60,000 distribution from her 401k. What amount of tax is she going to pay? 33%?
Plus the 10% penalty.
There we go. All right, 33% of 60 plus a 10% penalty, which is going to be the 6. And so that's what actually gets people. And I know I've mentioned this to you guys before, but sometimes people will anticipate the 33% tax, and they will not be told about the 10%. Because what gets relayed to them by their broker is you're going to have to pay taxes. And it's, so they say, okay, I got to pay taxes, take tax out of it. They take enough tax to possibly cover the 33%. What they don't do is take the penalty. And look at that, a penalty on $60,000 is $6,000. That can make a significant difference when you're trying to plan. That doesn't take into account the fact that you just maybe jumped a tax bracket also. All right, I think I just, nope, I thought I jumped a slide. Okay. Then it's what you guys were just asking about, required minimum distributions. Once you hit 70.5, or when you retire, all right, whichever's later. So that's the other thing too, whichever one is later. You have to start taking money from your plan, whether it's defined, whether it's a defined plan, or whether it is contribution plan, all right? Whether it's 401k, you have to start taking distributions from it. If you are still working, you do not have to take those, so you can still contribute to the plan. All right, you can defer your first payment, your first distribution, to the April 1st of the next year, based on when your birthday hits. You can do that. And there's a 50% penalty if you don't take it that first year. So it's something that you really want to kind of pay attention to in the year that you turn 70.5, assuming none of us are still working at that point. We hope we're not, but I don't know. Okay, so assume that Dave retires at the age of 72. He retires at the end of that year. Assume his 401k balance has a balance of $3.5 million. What is the amount of the minimum distribution for which he must receive in 2016, and when must he receive it by? So how are we going to figure that out?
Well, we know he has until April 1st of the following year, right?
Right, we have April 1st of 2017 to take it. And based on what you see in this example, are you willing to bet there's probably a table somewhere that tells you how much you have to take? You hope so. Because there's not enough information in here for you to figure it out. There is a table that goes through and tells you. I gotta move. All right, so required minimum distributions is on page 1310, and it's exhibit 13-3. It gives you the age. Now this is just a abbreviated table, but it gives you the age, the distribution period basically, and then it tells you the applicable percentage that they have to take. So based on that age, that's what percentage he would have to take. So we're looking at that table. And his age, he would have to take 3.92%. Now they pulled that directly from the IRS table. So he'd have to take $136,850 by April 1st. And there's a couple other examples, example 13-8, where you can also go through and kind of make sure you're understanding how to read that table. Okay, so let me ask you, I'm going to read you guys this little ethics question, because now we're talking about the next thing after we leave defined benefit and defined contribution plans is just talking about traditional 401k and Roth 401k, which is typically what most people talk about, because it's something that even if we don't have something at work, or we do have something at work, a lot of times we'll invest in those outside of work. So here's a scenario. Ryan just finished his finance class and had learned the importance of time and money. So with this knowledge, he wanted to start saving for retirement. Last year, Ryan had a job and earned $2,000. After paying expenses, he placed the remaining $500 in a savings account. This year, however, he decided to focus on studies, so he did not earn any income. He paid his living expenses through student loans, and at the end of the year, he contributed $400 to a Roth IRA. On his tax return, Ryan reported $400 of self-employment income, even though he didn't earn any. Why do you think Ryan reported this phantom income, and what do you think of his strategy? So one year he made $2,000 and he put saving money in a savings account. Well, if you guys ever put money in a savings account, what's your interest rate? Next to nothing. Okay. So the next year he didn't make any money. He was going strictly to school, but he put $400 into a Roth IRA. And he put $400 on his tax return into self-employment income that he really didn't have. Why would he do that?
Because the Roth is after-tax contributions.
Okay.
You probably can't contribute if you don't have after-tax income, can you?
You're on the right path, but not quite.
And he thinks he's gonna take the standard deductions, so
No.
he's gonna lose everything.
No, not that it's. You're on the right path with what you were kind of saying. Why would he have to claim income?
Because he couldn't contribute to the Roth IRA if he doesn't make an active income on.
Okay, you cannot contribute to a Roth if you don't have earned income. Passive income does not count. Interest and dividends does not count. You cannot contribute to a Roth IRA if you do not have earned income. So if he put $400 into a Roth, and he really is only going to put it into a Roth because it's after-tax money that he had, right? And why put it into a 401k if you already paid tax on it? You could, but the advantage is for a Roth. He put it in there. He can't do that unless he reports income. So he put in phantom tax income. Well, he's not going to pay tax on that self-employment income because he didn't have any other money. So it's not going to hurt him from a tax standpoint. $400 of self-employment income, is that going to be something that's looked at on a tax return with nothing else on it? No, not at all. So what do you think of a strategy? Would you do it? Would you report false income so that you can put money into a Roth?
He could do it till April 15 from the next year, but after that.
He'd still need a job, though.
Huh?
He'd still have to get a job. So,
No, but if he worked for the previous year.
right,
And he contributed till April 15.
right.
from
But
this
we're
year,
assuming he didn't.
So he could do it.
He could. This is made up income. So what do you think? Would you do it? Would you make up income?
It doesn't sound right.
It's not, yeah. It's unethical. All right? He's reporting income that he didn't have so that he can put money into a Roth IRA. Otherwise, what he's doing, he can't do. So even though it has no tax implications, regardless, because he doesn't make enough money to pay tax on it. So even if he really had $400 from self-employment, he wouldn't pay tax on it. So from that aspect, it's not changing his taxable income. But what he's doing is unethical from the standpoint that he's reporting false income so he can take advantage of a Roth, which is not right. So no, hopefully you do have a problem with it. That's not something that we should do. Okay, so Roth, did I skip ahead already? I did. Okay, so traditional IRAs before tax, so that means the tax is deductible. Distributions are the same as any other plan. We got to pay the 10% penalty, and when they come out, they're taxable. Roth IRA contributions are made after tax, which is what Ryan was doing. He had money that he'd already been taxed on. Not tax deductible, so you cannot put, if you make a contribution, it is not tax deductible. Employee contributions must go into a 401k They do not go into a Roth. So when you put money in, if you are not putting it into a defined contribution plan or benefit plan, if that's not what you have at work, and you're putting in defined contribution, it's going into a traditional IRA. It's not going into a Roth. There's two different types of Roths, all right? There's a qualified and there's a non-qualified. All right, a qualified is an account open for 5 years. An employee has to be 59 and a half. So once you open it, it has to be open for 5 years. All right, an employee has reached 59 and a half. That's pretty specific. Non-qualified distributions are taxable. Well, they're taxable because we put the money in after tax, but whatever we gain is going to be taxed. Right? Distributions on earnings are subject to 10%. Everything is subject if you're not 55, if retired, and 59 and a half if not retired. And distribution from contributions are not taxable. That's the benefit. So with a Roth, you put the money in now. The only tax you're going to pay later is on what you earned. All right? So that is why a lot of people see a Roth as an advantage, is you have the money now, you pay tax now. Later, you don't pay the tax. You just pay the tax on the earnings. Some people look at a regular 401k and they say, I'd rather pay tax now. My tax is going to be lower in the future because my income is going to be lower in the future. It really is just a tax strategy you got to have in your head. Non-qualified plans can discriminate, and basically you're usually giving those to higher level employees. Usually those type of plans have investment choices and the risk to employees in electing to defer type of salary choices. We get to deduct for tax purposes when we pay them. So when we put the money in is when we deduct for tax purposes. We include it in our income when we receive it. That's pretty self-explanatory. So with deferred compensation, what are we doing? Well, some of the things we got to think about when we're deciding how and what we want to do with our investment is employer and employee current tax rate. Where do we sit right now? What's our tax rate? Employer and employee future tax rates. And that's what I just mentioned. You got to think to yourself, and I have to say all my money goes in after tax right now. So I am not the financial advisor. So if you're looking, I can tell you about the tax implications, but I can't tell you which way to invest, okay? I will tell you that my train of thought for retirement is I don't want to make any less money than I'm making now. I don't care that I'm not supporting 3 kids. Somebody's going to come back, and somebody's going to need money, okay? I just feel like they're never going to go away, okay? But even if they do actually leave, when I retire, I want to be able to enjoy the retirement. I want to be able to travel, and I want to be able to come back and see my grandkids. So when I retire, I don't want to make a lot less money than I'm making now. I want to be able to retire and have basically the same amount of income that I have now. Yeah, I don't have 3 kids, but I'm going to take the money I'm spending on those 3 kids and hopefully not have any student loans I'm still paying off and be able to travel. If I drastically reduce my income, yeah, I'll be fine, but I'm not going to be doing anything extra because I'm just going to be doing what I'm doing now without 3 kids. I want to be able to have fun. So when I look at my tax rate now versus the tax rate I'm going to pay then, I don't see any difference. So when people say I'd rather put it in now versus, pay the tax rate, it'll be lower in the future, I don't know that my tax rate's going to be lower in the future. I don't know how we can say that. Look at the switch we just had with the presidents now. We don't know what's going to happen between now and next year. So how do we know that between now and when we retire, what's going to happen with the tax rates? So my philosophy is just tax it, or don't tax it. Let me save it now, and I'll just see what the heck happens when it comes back out. I don't know. But that's just one way of looking at it. Majority of people do tend to put their money in tax-free now. and they're going to kind of roll the dice when they take it out. You also want to look at the employer's cost of capital and the discount rate, and the employee's cost of capital and discount rate, and there you're getting into some very specific variables of financial investment of your money, getting outside of the tax aspect. All right, so what about individual managed plans? Okay, so now we're stepping outside. So when we're talking about the 1040, we've already had what we could have through work, the defined and the contribution. So far, those affect our taxes how? If right now, if every one of us in this room had a defined plan and none of us were retired and none of us took a distribution, does it affect our taxes? Nope. It doesn't matter if it's defined or if it's contribution, does it? I guess if it's contribution, it's reducing our taxable income. Okay? But that's it. And that's not really affecting our taxes from my viewpoint because it's going to show up on my W-2 and it's going to reduce my income and it's just going to be a lower line 7. All right? All right, then we looked at Roth and we looked at IRAs. So if we're not getting a defined and we're not getting a contribution through work that way, but we're getting a Roth or we're getting an IRA, do either one of those affect us right now? One does. Which one? The Roth. Okay? So the Roth, out of those 4, the Roth is the only one that could possibly, and I'm going to come back to this, affect us one way. And the fact that we get our money first, and then we actually have to go put it in an investment. Whereas the other 3 plans are taken care of possibly for us, in the sense that they're put directly in from our paycheck. If you want to invest in a Roth, you have to do the investment for yourself. The company can't do it for you. All right, you have to do it yourself. But is there a tax difference on a Roth right now? Don't you pay taxes on your income? Okay. So that actually doesn't affect my tax return right now, because I'm paying tax on it like I would any other income, and then I'm taking my bank account, I'm writing a check, and I'm putting in a Roth. Nothing changes. But what about on a 401k? Could it not affect my taxes? Can I get a tax deduction for contributions to a 401k that are not part of my work? Right, yes. So of those 4, really the only one that affects my taxes, the only one that gives me a tax break, is contributions to a 401k that is not part of contributions to my work. And that's because we're doing it after tax. Whereas a normal 401k at work is going to come out pre-tax. If we write a check to a 401k, we've already paid tax on that money. So that's why we get a tax break. So speaking of that, individual retirement accounts, what is our contributions? Okay, so you're generally not allowed to participate in this if you have an employee-sponsored plan. Because if you have an employee-sponsored plan, you're going to put your money in pre-taxed. It doesn't make any sense to get a tax deduction when you can be tax-free. And I know I've said that to you guys numerous times this semester. A tax deduction is not as good as being tax-free. The one thing I found over the years is people like to see it being on their tax return. When they see a tax deduction, they feel like they're getting their money. But a tax deduction is never as good as just being 100% tax-free. And if you take it out of your paycheck, it's tax-free. And that's one thing you want to try to get across to people. So for single taxpayers, deduction is allowed if they participate in an employer plan, but their income has to be pretty low. The lesser of $5,500 or earned income, and if you're over 55 or over 50, it can be $6,500. They're allowed what's called a $1,000 catch-up. So you can make non-deductible contributions, all right, and it's deductible plus non-deductible cannot exceed $5,500. So you can put money in. You can put it in up until, and Zaid already said this, up until April 15th of the next year. So we're getting ready to end this year, you can still make contributions into a 401k up until April 15th, and it will count to last year. And a lot of people do that. They wait and see where their tax return is, then they see, could I benefit from putting money into a 401k? My friend that puts money in, even though he's retired, that's when he does it. Does his tax return, we figure out, okay, if I put $5,000 in, what would it do? Well, it's going to save you X amount of money. Okay, let's put $5,000 in. What does he have to lose as long as he has $5,000? Because he can turn around and take it back out again. So that's kind of his philosophy. And again, distribution is the same. There's some exceptions, okay? You can take 401k money out for medical reasons. You can take it out, obviously, for the first home sometimes, okay? That is kind of a yearly thing, depending on what's going on with 401ks. And you can also take it out for insurance premiums. But that was new, actually. That was something, when I first saw that last year, I had to look that up. That's something new, that you could take it out for your premiums. And I think that's when they started becoming with Obamacare and the premiums got a little bit higher. I think that's when you could do that, because that was something new. Medical expenses have always been in there. They used to have hardship on there, and that went away. It kind of surprised me. You can always distribute from a 401k for divorce, because that's sometimes mandated and you don't have a choice. And so there's no penalty if the courts tell you have to liquidate your 401k. And sometimes it's not the whole 401k, sometimes it's half, or whatever percentage you have to give to the other one. All right, Roth. So Roth has the same limit. It's phased out based on AGI. So that is a little different than the 401k. It's phased out. Now, one of the things with Roth that a lot of people don't realize is that because your money goes in after tax, you actually can contribute more. $5,500 after tax is more money than $5,500 pre-tax. Because if I put $5,500 pre-tax in there, and once you pay, let's say it's $5,500 at 30% tax, I'm really only putting in what? $3,800 or something like that, maybe $4,000. But $5,500 after tax is $5,500. So there is a difference. You're putting in more money with a Roth. You're able to put more money in. All right, so the distributions are never taxed. So you can take your money out. It's going to be fully tax-free except for distribution. The money that's earned. Qualified distributions are not earned. Now, there are a few restrictions, and sometimes that fine print's not always read by everybody. You have to have the Roth open for 5 years. You cannot take it out. So you put your money in, and then you decide after 2 years you want it back. That doesn't work. You cannot roll it back over into a 401k either. It has to stay in the Roth for 5 years. So it has to stay for 5 years, and before you can receive any distributions. You also have to be over 59 and a half or pass away, okay, in order to take it out. You can use it if you're disabled, or you can actually use it for up to $10,000 for your first home. We already talked about there is no minimum distributions on a Roth, so that's a difference as well. I do know quite a few people that have a balance between Roth and 401k, that they have some money in each one. And so that's an option you can do as well. So there are the tax consequences. Well, if I already paid tax before I put it in, what am I going to pay tax on? Something. If I put in $10,000 a year for 10 years, that's $100,000. But when I go to take the money out, if there's $150 in there, what am I going to pay tax on? I'm going to pay tax on the 50. Not the 100.
With the Roth IRA?
With the Roth, you still got to pay tax on what you earn. Not on what you put in, because you already paid tax on it. All right. Now with the 401k, if I put $10,000 in every year, I'm putting $10,000 in pre-tax. So after 10 years, or whatever I said I was, $10,000 a year for 10 years, that's $100,000, plus I earn 50 I'm now gonna pay tax on $150,000. So with the 401k, I'd pay tax on 150. With a Roth, I'm gonna pay tax on 50. The Roth doesn't get you out of tax on your gains. It just gets you the fact that you pay tax on the income when you got it, and then you're putting it in after tax, so you don't have to pay tax on that later. So why roll your money over? When Roths were first opened up, honestly, I don't remember how old I was, but I do remember I was old enough in the sense that I think I was working out, and there was a mass rollover. There were so many people that wanted to take their 401ks and roll them into Roths that there was not a penalty. People were able to take their money out of 401ks, tax penalty free, and roll it into a Roth. So you didn't have to pay that 10%. There was I can't remember how long it was. It was a year, it was 18 months in which where you did not have to pay that 10% penalty. And as long as you took your 401k and you rolled it into a Roth, you did not have to pay that penalty. I don't know why. It was just, some of it was this new appeal, some of it was the fact that it was like, wait a minute, that's kind of cool to put money in after tax and then just have to pay it on the gains. Now, when you rolled your money over, you had to pay tax on the money, but not the penalty. Because obviously if it's in after tax, you got to make sure it goes in after tax. But there was a huge amount. And then over the next several years, it slowed down and some people moved their money back. Again, I'm talking about the tax implications. I can't tell you which one's better. That's not what I do. So let's look at an example. Tina graduated from college, began working for the company. She made a fully deductible $4,000 contribution to a traditional IRA. 3 years later, when her marginal tax rate was 25%, she withdrew the $5,000 balance in the account and rolled it over, or contributed, $3,750 to a Roth. What amount of tax and penalty is she required to pay on the rollover? All right, so she contributed a fully deductible $4,000 to a traditional IRA. Now she's going to roll over the balance, which was $5,000.
Do you still get out of a penalty?
No, that was only for 18 months, and that was a long time ago.
So she's going to pay 35% on the $5,000.
Okay, now is it 35% or is it 25 and 10? And there is a difference. 35% of 5,000 is going to be, do the math, but 25% of 5,000 and 10% of 5,000 is different. Okay, you come up with two different numbers, so you'd want to make sure you don't do them together. 25% of 5,000 and 10% is higher than 35%, so you want to make sure you do those two separately. So what is her tax and what is her penalty? Her penalty is going to be easy. 10% of 5,000 is $500 penalty. What's her tax on the 5,000? What's 25% of 5,000? $1,250. All right. So that's where you're at, the $1,250. So $1,250 in taxes, and then it says $125 penalty. The penalty is 10% of the $1,250 that she withdrew from the IRA and she did not contribute to the Roth. Now, that is interesting because what did I just tell you the penalty was? I said $500. But let's back up a page. When I did that, first of all, I did it wrong, okay? Because I did 10% on the balance, but she didn't keep the balance. She rolled over $3,750. So it just so happens that the 25% is $1,250, and then what she didn't roll over is also $1,250. So she rolled over $3,750 into Roth. She doesn't have to pay a penalty on that. All right. So when you look at, she must pay $12,500 in taxes because when she takes the money out of the Roth, she has to pay taxes on it. All right. Or I'm sorry, when she takes out the IRA into the Roth. And then the $125 penalty, the penalty is 10% of the $1,250 that she withdrew and she's not going to put into the Roth. So the rollover, if it's immediate, Lisa, I was incorrect in that if it's immediate rollover, and I don't know why I didn't say this right the first time, immediate rollover from any 401k to a different 401k or any 401k to a Roth or backwards is going to go without the penalty. But it has to go into another retirement account.
And from working in a bank, it has to go directly to it. They can't give you the money and then
Actually,
you take it to the bank.
You now can, and it's sad. You should not be able to, but you now can.
Because you didn't used to.
You didn't used to be able to at all. You didn't
If I
used to
touched it,
even
I
want,
was done.
you didn't even used to want to get the check.
No.
You didn't want to touch it because you didn't want them to misinterpret the fact that you had the money. You now have, I think it is 60 days from the time that you take the money out to the time that you have to put it back in. Because I actually found out, and I fought it, I had someone in here for VITA who took a distribution from their 401k and they actually went to the casino. They went to the casino with the money, they gambled with the money, and then they put the money back in. That is, in my mind, that every bit of that is completely wrong. But the laws now, whatever state, that you can withdraw it from your 401k, and as long as you roll it back into another retirement account within 60 days, it's a rollover and it's not taxable. Now, when we bought our house, we actually took money out of a 401k, and we did do that, but we were trying to sell our other house, so we took it out, and we were like waiting for that money to come in, and I did get it rolled back in. But it was like one of those things where I took it out, kind of like, here's the down payment, but we got to sell that house real quick before we, to get that money to roll it in, and we did get it. And it made me very uncomfortable because I did not think that's where the rules were. And our agent and the financial guy kept saying, nope, you got 60 days, as long as you get it back in within 60 days.
So it's kind of borrow money from.
That's exactly, and that's what made me really uncomfortable. It's almost like you got money you can borrow, but you have exactly 60 days. And I actually sent that check back to my 401, whatever, Mass Mutual, American Fund, whoever, the 401k people. I sent it back certified mail overnight because I was so worried it wouldn't get back into the account within that 60 days. And we had like a 5-day window at the end with the selling of the house, that I was just kind of like, I got to make sure that check gets back in there, because if it didn't, then, you miss it by a day, it's 10% penalty. Mm-hmm. And with buying a house, it was kind of a decent amount that got taken out, so I wanted to make sure it got back in. But the whole thing with the casinos, completely not what that was meant for, So, but Lisa's right. It used to be extremely rigid, to the point that you didn't even, when I left Southwestern Bell and I had my 401k, I had them mail it to my new place, and they didn't want to. I'm like, mail it directly there. I don't even want the check to come to my house, because you didn't want to take possession of it. Yeah.
Check would be issued to Glacier Bank for benefit of.
Yep, you didn't want to take possession of that check, because then it was your money and you didn't roll it over. You didn't want that to happen. Now, on your 1099 that you would get, it will be a code of a G. G means it's rollover, and that should mean it's not taxable. Okay, if you're self-employed, you have two different options. All right, obviously you're self-employed, you don't have a defined plan, you don't have a contribution plan, you don't have a 401k plan through work. But what you do have is you have an SEP, simple employment plan, or you have an individual 401k that you have through work. Your contribution limits are the lesser of $53,000 or 20% of whatever your Schedule C is, minus your self-employment tax or your employer's portion of the self-employment tax. Your employer's portion is 50%. That's just kind of a reminder, but 50%. If you have this for yourself, you have to offer it to your employees. So if you have an SEP for yourself, you have to offer the SEP to your employees. You cannot give it to yourself and not give it to your employees. So Dave is 64 and is director of compensation. During the year, he's reimbursed for all expenses. Due to the specifics of the work arrangement, he is treated as a self-employee. If Dave sets up an SEP for himself, what is the maximum contribution he can make to the plan, assuming he has no other source of employee or self-employment income? So, he makes $40,000 during the year. What do we think?
We have to deduct half of the self-employment tax.
Yep, yep. So half of the self-employment tax is going to be, it's kind of tricky when you look at doing it. The first thing you got to do is you got to actually take 0.9235, okay? You got to come up with what is the Medicare, and then Medicare plus Social Security, and then you take half of it. So you're kind of backing yourself out of it. And then the percentage for limitation is 20%. So you end up taking number 2, which is that calculation times 20%, and that gives us $7,435. That's the most he can contribute during the year. So based on a salary of $40,000, the first contribution limit's $53,000, so obviously he's underneath that. So then his maximum is $435. So way under that $53,000 contribution limit. Now, look at the difference here. Now, if you're going to do an individual 401k versus an SEP, you still have the $53,000. You still have the 20% of the Schedule C minus the Social Security, but you get to add $18,000. In addition, if you're over the age of 50, you get an additional $5,500. So the maximum contribution, though, is still that $59,000 that we talked about before. So we're still going to use Dave. Dave still makes $40,000. The difference this time is he's going to do a 401k instead of an SEP. Now, look at the difference. He still has the $37,174, so that did not change. So that is exactly the same as it was. So he still has the $37,000 that he calculated. The limitation is still 20%. He still came up with the $7,435, but now he gets to add $18,000. So he comes up with $25,434. And then he has what's called the catch-up contribution, which he's over that 50,000. He's over 50 years old. He gets to add another $6,000, so he can actually contribute $31,000. He cannot exceed $59,000, but he can contribute up to $31,000 if he can. Now, someone who's making $40,000 probably isn't going to contribute $31,000, but I guess you never know, okay? But that's the maximum that he can contribute. So look at the difference between the two. So this is $31,434, and if we go back to SEP, it's $7,435. So 2 retirement plans, and it's a difference of over $24,000. Now, is someone going to contribute $24,000 more on a salary of $40,000? Probably not. But could they contribute a couple $1,000s more? Maybe. You know, Dave's, what'd they say? We said Dave was 64 years old. Dave could be working a second job. He could already be retired. And, you know, I hear about this more like in the public school district and stuff, but I'm sure it happens in private school districts where superintendents retire and then they go to a different state and work. So like, for example, if they retired from Melville or Parkway or Lindbergh School District, they're going to collect retirement from the state of Missouri. If they go to Illinois, they can work. They can be a superintendent, they can teach in Illinois. They can't work more than a certain number of hours in Missouri because they're retired and they're collecting their pension through the state. So they can't work and collect a pension. But if they move out of state, then they're collecting their state pension or whatever from here, not from the state that they're living in. So they kind of get around it. So if someone were doing something like that, they could possibly be drawing quite a nice pension, and this salary could be bonus salary. And if it's bonus salary, then you could be contributing a lot of money into a 401k so that you can reap the benefits from a tax or whatever you wanted to do with it. There's always something. Okay, and the reason I point out some of those things is those are the tax loopholes and tax shortcuts that a lot of us never get to take advantage of. All right. I can tell you that, like, once I retire from the state of Missouri, I can only teach, like, I think it is 2 classes a semester. So I can retire and I can still teach, but I'm limited on what I can teach. And it's not 2 classes here, it's 2 classes in the state. Because if I'm drawing a pension of whatever, and how much I get is based on when I retire and my age. All right. And how long I teach, obviously, how long I teach. But so if they're going to be paying me based on my salary, based on how long I taught and how old I am, so let's say I retire at 65, they're then not going to turn around and say, well, I'm going to work full time, you're going to pay me my full-time salary, and you're going to pay me retirement. They're not going to let you do that. And then you're still paying into your pension. So basically, once you retire, you can still teach, which a ton of teachers do. But they're limited on how many they can teach in a year. And I believe it's 2 classes a semester, and I think 1 in the summer. It might be 2 in the summer.
Periods or 2 whole classes?
2 whole classes. And it's like, I think it's 6 credit hours. I'm not positive because, like, for example, financial accounting's 4. So I don't know if it's 6 in a semester or if it's 12 in a year, but it's something right around that 12 to 15 hours total in a year, because we've gone out, like when I was at Wildwood and I first got hired out there, I went and tried to get a retired teacher from Flow to come teach, and he couldn't because he was teaching 1 class at St. Charles and 1 class at Flow, and that was all he could teach. So they limit him. And it's not a horrible thing. My mom teaches here. She's retired. She's not limited because she's drawing from Ohio. But she's limited because she doesn't want to teach that much. So she's not abusing it. She's teaching 2 classes. Sometimes she teaches 1, sometimes she teaches 2. But she's not technically limited from the state of Missouri because she's drawing her pension from the state of Ohio. So she could be one of those people if she chose to. But when she moved here, she did not choose to. She was retired. When she retired from high school teaching, she was not one of those teachers that went back and subbed. She was done. So she did not go back. Did you have her for business, ma'am? She's old school.
Yes, she is?
Yes, she is.
Yeah, I like old school. Which
Yeah.
teacher do you have?
Sandy Cottle. Business math is the only thing she teaches.
Okay.
She's a math teacher. So, but she always taught business math at the college back where I'm from. But she never taught like what she taught in my high school, but she never taught classes I was in. So growing up, she started teaching there after I was in school, so she always just taught a grade level below me. And she just loved teaching developmental math. And that's just a special person. And business math, why it's not developmental, is lower math from a standpoint that that's what you need to do business statistics. And so that was a natural fit for her at the college. But in the high school, she just loved it. She loved being successful with people that just weren't doing good in school. So she always just taught whatever I wasn't in. That way people couldn't say that she helped me. And then my younger brother came along and she kind of did the same thing. So, but yeah. Definitely could not say I couldn't do good in math, so because of her. there's a couple charts in your book that I think are helpful. Page 1312 has a summary of the defined benefit plan versus the defined contribution plans. And it goes through and it just says who can contribute, what's the payout, how do they pay out, what's the vesting period, and other factors that you might want to pay attention to. Page 1315 talks about 401ks and Roths. Now, honestly, the most common question I get over and over again is Roth versus 401ks. I get that from just people all the time. They don't understand the difference between those two. So that right there is something that no matter what you plan on doing after this class, I would just continue to know the difference between a Roth and a regular traditional 401k. And that's on page 1314. And then on page 1319 is Exhibit 13.7, and it kind of just tells the difference between qualified and non-qualified plans, where qualified plans cannot discriminate based on rank in life, and non-qualified plans can. I think that was my highlight from then. So, okay. So, now all that information, and then they have another summary of traditional on page 1326. All this information on your 1040 goes on two different places. So, the first place that when you report the income, your IRA distributions are going to go on line 15A. That's one of them. And 15B. And there's the distinction between the two is 15A is the full distribution and 15B is the taxable. Not all of your distribution will be taxable. We talked about that, right? If it's a Roth, not all your distribution is going to be taxable. If you take a distribution of $100,000 but you put in 50, your distribution in 15A is going to be 100. Your taxable is going to be 50. That's what they're looking at. On your defined benefit plans, they would fall under 16A and B. If it's completely defined, then it's paid for by your employer, and 100% of it's going to be taxable. So 16A and B are going to be the same. If it's a defined contribution plan, then 16A and B could be different. Because if you're contributing money, then that is not going to be taxable if you paid tax on it before it went in. It depends on how you put the money in. So 15A, B, 16A, and B are what we talked about today. There's a line down here. 28 is self-employed, simple, SEP, and qualified plans. You will also see IRA deduction. Right. Those two things are on there for when you are using them as an adjustment, because that is something that is offered as part of your business. So, and the IRA deduction is because you contributed to an IRA. So that's where your IRA deduction goes. All right. And then the SEP and qualified plans, that would flow through. That's not necessarily what you contributed. You do have to go through and look at the worksheets. That's not a one-for-one. And then penalty on early withdrawal from savings, that is not where you put the 10% penalty. That is literally a penalty on early withdrawal from savings accounts. That's just your savings accounts. Some savings accounts are set up with a penalty. That's what that is. When you take a distribution and you have a penalty for distribution, it is going to go on line 59, additional tax on IRAs, other qualified retirements, etc. So depending on what you got taxed on, Roth, IRA, 401k, your defined benefit plan, anything that you took an additional 10% tax on, that is where that's going to go. So the 10% does not go for AGI, it goes from AGI. And then the last thing that we have in the chapter is something called the Savers Credit. The Savers Credit is typically for lower income. It doesn't have to be extremely, extremely low, but it's for lower income. And basically what it is, it's a credit for people who, while having a lower income, still contribute to a qualified savings plan. It's basically saying, you're doing a good thing, here's a credit for doing so. It also can be a credit for additional contributions, like you're already saving, but now you're saving more. So it depends on your filing status. So here's the kind of the breakdown. If you make above $61,000 and you're filing jointly, you don't get it. So the income level threshold can kind of be low based on where you're at for the Savers Credit. It's for, I just went backwards, didn't I? Oh, that was the last one, that's why. And so depending on where the Savers Credit is going to go under all other credits, line 54, which if I come back over here, is on the second page of your 1040. And so it would show up just as your credit, and that would be filled out based using on your wonderful Savers Credit form, which is, it's actually, they don't actually give you even the form on that. It can be up to $2,000 actually, depending on your limit. It's phased out. And it's 20% of the amount that you contribute, is how it's calculated. 20% of the amount you contribute up to $2,000. Now, I can tell you in VITA, there were several people that got the Savers Credit. So a lot of the ones that you saw get it were contributing on or through their work. So they were making, I don't know, $25,000 to $30,000 at a work environment, but they were saving through their work plan. So they were making, yeah.
So when they gonna take the money back? 59
Well, without penalty, 59.5, yeah. Because it's still a retirement plan. It's called Savers, but it's not a savings account. They're saving for retirement, so they're getting a additional tax credit. Because obviously, if they're putting it in their 401k, they're not paying tax. So that is a credit or a tax credit. But they're getting an additional credit on their tax return for saving at lower income. Basically, it's an incentive for people that aren't making a lot of money to save. Everything, every tax credit that is given every year is an incentive. That's all it is, with the exception of maybe child tax credit. I'm not sure that's supposed to be an incentive. That's after fact. But, you know, all the residential energy credit, okay, when they give you a credit to replace low efficiency air conditioners or to put insulation in your attic, that's incenting you to do things that are more efficient, right? When they give you a credit to go buy a new home, why were they giving us credits to go buy new homes in 2008, 2009, 2010? Exactly. The market dropped. They were trying to get people to go buy houses. When people buy houses, it stimulates the economy. When it stimulates the economy, people get jobs. So basically, here's $10,000. All right? The first one they did was $7,500 and you had to pay it back. The next year it was $10,000 and you didn't have to pay it back, which kind of really sucked for the people that got it the year before. But either way, it was still, the $7,500 was still a tax-free loan. And when you buy a house, if you haven't bought one before, you'd be amazed how much time you spend at Home Depot right after you buy a house. So getting a $10,000 tax credit right after you buy a house is very nice. And the way that the first two, the $7,500 and the $10,000 worked, is you could actually get them advanced. So in the year that you were buying, so if it was April and you were going to close on your house, and I can't remember exactly how many days, in the next 30 or 60 days, you could actually include it on your tax return for the prior year. That way you had the $10,000 before you closed on the house, which is even better, because then you could use it in the down payment if you needed to, or to pay the fees. So all these credits are really incentives. The education credit is an incentive because college education is not affordable. Now, does it come close? No, it doesn't. It doesn't come close to coming back and helping you pay for it. But it's supposed to be an incentive to help, all right, and that's kind of why it's there. Dependent care reimbursement is there to help parents go backwards and help pay for childcare. Doesn't cover all of it, but all those are just, all credits are based on going just incentive to get people to do different things. Because almost all credits can be taken away. There's very few credits that are permanent. You can tell which ones they are because they have their name up there. But it still doesn't mean they can't go away. But a lot of them you'll see under the other, that means those are other are things like Savers credit. That's a year-to-year credit. Residential energy credits are year-to-year. They just say residential energy. They're not specific on what they are. All right.